Right now, as we look at the market action on this Monday morning, December 8th, Supermicro Computer Inc. is trading at exactly $35.05 USD. We are seeing a push to the upside, with the stock up $0.36, representing a gain of 1.04% regarding intraday movement as of 9:44 a.m. GMT-5. When you see a number like that, a modest 1% gain in a stock that has been historically known for wild double-digit swings, it is easy to be lulled into a false sense of security. You might look at that green number and think the worst is over, or that the market has found its equilibrium. That is the expectation, stability after the storm, but the reality is far more complex and, frankly, far more dangerous. What we are seeing at $35.05 isn't necessarily a recovery. It is a breathless pause in a high-stakes negotiation between market confidence and regulatory survival. The market wants to believe the accounting saga is resolved, but the price action tells us that the big money is still hedging its bets, waiting for the other shoe to drop or for the definitive all-clear signal that hasn't quite arrived yet. To understand why this price point matters, we have to strip away the noise and look at the raw mechanics of the last few weeks. The volume behind this move is telling. We aren't seeing the massive capitulation selling that drove the stock down from its highs, but we also aren't seeing the aggressive, high-conviction buying that characterizes a true reversal. Instead, we are in a zone of accumulation and distribution that feels incredibly tense. If you're watching this on your Fidelity mobile app or tracking the ticks on an interactive broker's trading screen, you will notice that every time the stock tries to break significantly higher, it hits a wall of resistance. This is where the bag holders from higher levels, people who bought in the 40s and 50s, are looking for an exit, and where short sellers are reloading their positions, betting that the company's compliance issues with Nasdaq are far from over. It is a battleground, plain and simple. The narrative surrounding Supermicro has shifted violently. Just a few months ago, this was the darling of the AI trade, often mentioned in the same breath as Nvidia stock or even Tesla stock regarding momentum. It was viewed as the essential plumbing for the artificial intelligence boom. Now the conversation has moved from how high can it go to will it stay listed? This shift from a growth narrative to a survival narrative is the single biggest factor suppressing the price. While retail traders using Robinhood app or SoFi Invest might be looking at the low PE ratio and thinking this is the bargain of the century, institutional desks are paralyzed by the governance questions. They cannot model the future cash flows until they know for certain that the past financial statements are accurate. That uncertainty creates a discount. And that discount is exactly what we are staring at right now at $35.05. Let's look closer at the intraday dynamics we are seeing today. The open was tentative. We didn't see a gap up that screams news leak, nor did we see a gap down that implies panic. We saw a measured open, followed by this 1.04% drift higher. This suggests that the immediate selling pressure from the auditor resignation news cycle has been absorbed. The market has digested the worst-case scenarios, delisting, restatements, management changes, and is now trying to price the company based on its actual hardware business again. However, the liquidity is thinner than it looks. When you look at the order book, the spread between the bid and the ask widens considerably during volatility spikes. This indicates that market makers are wary. They are protecting themselves against sudden headlines. If a new filing drops or a new statement comes from the special committee, this $35 price level could evaporate or it could skyrocket in seconds. It is interesting to contrast this with how investors handle other tech giants. When you buy Apple stock, you are largely buying certainty. You know the cash pile is there. You know the buybacks are coming. With Supermicro, you are buying a probability. You are betting that the underlying business, the servers, the racks, the liquid cooling technology is so strong that it will eventually outweigh the governance headaches. This is a classic value trap versus deep value debate. Clients using Schwab Intelligent Portfolios or seeking investment help from traditional advisors are likely being told to stay away until the dust settles. Fidelity Wealth Management advisors are probably flagging this as high risk in client notes. Yet the price is creeping up today. Why? Because the underlying demand for AI servers hasn't stopped. The business itself is likely still printing revenue, even if we don't have the filed 10K to prove it yet. That disconnect between operational success and administrative failure is the friction point driving today's action. We need to address the elephant in the room, the server market competition. While Supermicro is dealing with its internal chaos, competitors like Dell and HP are not sitting still. They are aggressively trying to steal market share. Every day that Supermicro spends fighting for its listing status is a day that its sales team has to spend reassuring clients rather than closing new deals. This is the hidden cost of the current crisis. When we analyze the price of $35.05, we have to ask, does this price reflect a permanent loss of market share or just a temporary pause? If you believe the technology is superior, specifically their building block architecture, then the price is a steal. If you believe that enterprise customers crave stability above all else, then the stock might still be overpriced. Speaking of holding the stock, I want to hear from you guys right now. Comment below how many shares of Supermicro you currently hold and at what price you got in. Are you underwater and waiting for a rescue? Or did you buy the dip in the 20s and are sitting on a nice profit? I want to see where the sentiment is among the real traders watching this. Moving deeper into the technicals, the stock is currently dancing around its short-term moving averages. It is trying to reclaim the 20-day moving average, which would be a bullish signal for technical traders. If it can close above $36 or $37 in the coming sessions, it might trigger a short squeeze. Remember, this is a heavily shorted name. There are hedge funds that have made a fortune betting against this company over the last few months. But shorting at $35 is a lot riskier than shorting at $100. The risk-reward for the bears is getting worse. If the company announces that they have hired a new auditor and have a clear timeline for filing, those shorts will rush to cover at the same time. That is the coiled spring theory that keeps the floor under the stock right now. You can see this tension on platforms like Interactive Brokers, where the cost to borrow shares can fluctuate wildly, indicating just how crowded the short trade has become. Let's take a step back and talk about what this company actually does, because in the midst of all this drama, the product often gets forgotten. Supermicro builds high-performance server and storage solutions. They are famous for their green computing initiative and their modular design. Unlike competitors who might force you to buy a standard box, Supermicro allows data centers to customize their rigs with specific processors, memory, and cooling solutions. This flexibility made them the go-to partner for the AI explosion. When you need to cram massive amounts of heat-generating GPUs into a server rack, you need advanced cooling. Supermicro has been a leader in direct liquid cooling. This isn't just a buzzword, it is physics. Air cooling reaches a limit when you're running the latest chips. Liquid cooling is more efficient, allowing for higher density and lower power consumption. This is why they rose to prominence so quickly alongside the chip giants. However, having great tech is not enough if you cannot file your taxes or report your earnings on time. The crisis began with a report from a short seller alleging accounting manipulation, which was followed by the delay of their annual report, Form 10K. Things went from bad to worse when their auditor, Ernst & Young, resigned during the audit process, stating they could no longer rely on representations from management. That is about as severe as it gets in the corporate world. It is the corporate equivalent of a lawyer walking out on a client in the middle of a trial. This is what caused the stock to plummet from its glory days to where we sit today. The expectation was that Supermicro was a mature S&P 500 company. The reality exposed by these events was that its internal controls were perhaps not ready for the big leagues. Now, let's talk about the retail investor perspective. If you are engaging in self-investing or looking to invest online, you are constantly bombarded with conflicting information. You see a headline about delisting fears, followed by a headline about record server demand. It's confusing. Platforms like SoFi and Robinhood have democratized access, but they also expose individual investors to this kind of volatility without the support of a compliance department. If you are managing your own individual brokerage account, you have to be your own risk manager. You have to decide if a 1.04% gain today is a sign of strength or a dead cat bounce. The Robinhood crypto crowd is used to this kind of volatility, but for someone used to Fidelity mutual funds or Fidelity ETFs, seeing a stock move this way can be stomach-churning. The broader sector momentum is also playing a role here. We are seeing a rotation in the tech sector. Money is moving out of the mega-caps that have run up significantly and looking for catch-up trades. Supermicro technically fits that description, if it survives. It is trading at a valuation that looks absurdly cheap compared